Today, folks, we're going to talk about these Canadian bank stock earnings. For those of you that love to collect the juicy passive income, the dividends that these banks have been able to produce for decades and probably decades to come. But with the economic uncertainty we are barreling toward, there is a lot of concern with the rising loan loss provisions these banks have to put aside. Is basically mortgage delinquencies skyrocket, especially here in Ontario. We have tariff wars that could have ramifications that could hurt small businesses and cause further delinquencies on private loans, credit cards, and so much more. But we're going to break down the earnings. We're going to talk about these economic uncertainties as somebody that has exposure to these Canadian banks. So if you're on a path to financial independence, if you damn well one day want to retire early, let's do this together. Simply hit that subscribe button, folks, because we have a lot we're going to be diving into in this video. But let's start with the most concerning of the headlines. Canada's consumer debt hits a record 2.56 trillion as mortgage delinquencies surge. Now, if we scroll down and just take the headline out of this article, that more than 11,000 mortgages, specifically in Ontario, recorded a missed payment in Q4 of 2024, nearly 3 times the figure in 2022. Mortgage holders have fallen behind on payments and are carrying significantly higher balances, reflecting the impact of higher than pre-pandemic interest rates. The 90-day mortgage balance delinquency rate in Ontario surged 90.2% year over year to 0.22%. I want you to keep in mind, these are levels that haven't really been seen since 2015. And if we're talking about like a steam pipe here that's been building up pressure, we're not talking about the nuts and bolts flying off. We're still in a relatively strong place in the economy, but this is a concerning, trend that eventually has to come to an end. And when we look at the provisions for credit losses, I told you guys, we need to get through this hurdle. Once we're through this hurdle, I think we're going to head into a brand new bull market for these banks, but it's going to take about another 1 to 2 years, a lot longer than I was initially expecting. And that's primarily just because, hey, 60% of all mortgages are coming into renewal between now and 2026. And when you look at the, average debt on these, mortgages of 506,000, which I think the average probably isn't healthy because a lot of these are probably significantly higher. A lot of these people came in during 2020 and 2021, and now they're renewing, praying that Tiff Macklin, the Bank of Canada, the head there, is going to continue to cut rates because, again, when you look at 0.25% versus the 3% we currently sit at, that is still astronomically higher than where those people, initially got those mortgages. And if we take a look at the two largest banks, Royal Bank and Toronto Dominion, and I think Royal Bank is going to give you the best perspective because they have the most exposure to the Canadian economy over all the other banks, and it's also Canada's largest company. And we take a look at the 30 and 90-day delinquencies. As mentioned, when you look at the past due here, it is concerning. It is a trend that is trickling to the upside, but it's not like busting the pipes. We're not at levels where you need to be worried about the entire economic collapse and the sky falling. We're nowhere near close to that, but we are in a period where it's likely this trend could continue to go up, as all these mortgages come into renewal. But what's interesting is if we take a look right here, and I want you to pay real close attention to the chart here that actually shows the different level of loans outstanding that are in 30 to 89-day delinquent. Residential mortgages have actually leveled off for the bank, which I found hyper intriguing. HELOCs have leveled off, but when you look at like personal lending, credit cards, and the yellow line represents this year, 2025 Q1, you look at small businesses, you look at wholesale and commercial, these are actually experiencing the most pressure. And these are still higher trends than we've seen in the past, but it's nothing like if you go back to the 2015 to 2020 era. This is kind of more in line with where that era was at, which is kind of intriguing on what would have caused, more pressure in the economy back then. But again, these are trends that we can't see continuing because if this goes on for a perpetual amount of time, it's really going to hurt, I think, the banks in totality. If we take a look at Toronto Dominion, it's the very same thing. Gross impaired loans continue to trickle to the upside. So we'll see how this pans out. I was really hoping we'd be leveling off by now, but we're just not. So how do we protect ourselves? Now, before we look at the bank earnings, I just want to tell you the number one rule of thumb you need to be following if you're purchasing a property like I did in Toronto, and that is the 30% rule. And a lot of people, if they follow this rule, will not be able to afford a home. And you have to really understand this because basically a lot of people don't agree with it, but no more than 30% of your take-home pay, your household take-home pay, should be going toward a mortgage. That leaves you with enough room to be able to invest, to pay all your other bills in case of emergencies, in case interest rates go up. You can afford some of the fluctuating aspects of the economy. And you should also have an emergency fund on the back of that, right? So you need to do the calculation that, if your take-home pay, let's let's say your household take-home pay after tax is 100 grand, no more than 30 of that should be going toward a mortgage. Now, again, I know a lot of people don't want to believe in that, but I personally made it so way less than 30% of our take-home pay is going toward our mortgage. And I don't feel like any of these burdens that are affecting the Canadian economy are going to affect me. But keep in mind, my interest rate is at 5.8%, much significantly higher than most people's out there, because unfortunately, we got our mortgage literally during the peak of the interest rate cycle. So, we're in a comfortable spot though. We followed the rules and we're not facing this. It's the people down here that over leveraged, took on way too much debt, and now are realizing that they're going to be breaking at the seams and their steam pipe is starting to bust a nut. That sounds highly inappropriate. Nonetheless, folks, let's talk about the banks themselves though. And we're going to break each one of these down and just look at the top and bottom line to see what banks are performing. But Royal Bank, I still believe to be one of the strongest banks and is still showing quite resilience on the back of some of these concerning delinquencies. But nonetheless, the PE ratio is still a bit higher, but a 3.54% starting yield is not great, but the bank is trickling to the downside. And it has been one of the best performing banks after the purchase of HSBC. We're going to see another bank that is going into an acquisition, and I'm going to recommend you what I think the strongest bank to buy is right now. But if we take a look at the top and bottom line, total revenues exploded all because of the acquisition of HSBC, going from $13.48 billion to $16 billion is astounding, with $5.1 billion net income versus $3.58 this time last year. And keep in mind, provision for credit losses remain up at $1 billion. But when you're talking about a company that even over the last quarter went from $15 billion to $16.7 billion, like a $1.7 billion increase in revenue, and only saw about a $200 million increase in loan losses. I mean, they're in a very strong, solid place that really shows resiliency in the dividend, and they have a lot of room for uncertainty in this market environment. Because if you take a look and we scroll down, the dividend payout ratio dropped to 42%, the lowest it's been in a long time for this bank. TD obviously dealing with the fines they're facing from money laundering and all that. The bank got heavily suppressed, even though the company continues to grow quite strongly. A lot of people starting to see this as a great buying opportunity. And if we take a look, the dividend yield is probably one of the strongest amongst the banks, being one of the largest companies in Canada. But if we take a look at total revenue here, we can see it sits at about $15 billion, which is, again, like Royal Bank, significantly stronger than where it was at 13.7 this time last year. Basically, all in all, if we take a look at the income here with, we can take a look at provisions for credit losses first, I guess. Provisions for credit losses on this one at $1.2 billion is, again, another record level for TD, unfortunately, and has gone up again by another 100 million, and their revenue hasn't exploded as much as Royal Bank has, but they're still, again, sitting in quite a strong place with net income at 3.6 billion, relatively flat from this time last year. But again, they're in a good place. I think they're still trading at a relative discount, and they can still actualize a lot of income. But what we really need to see is the end of these. Again, it's not going to go away for the next 1 or 2 years. We're still going to see some concerns, especially if tariffs get implemented. It could really hinder a lot of small businesses, a lot of businesses perhaps exposed to oil, anything doing international trade. If these things come into effect, it's likely that loan losses will continue to go up. But again, unless loan losses go away, it's going to be tough for the banks to see that next level of what I'm going to call explosive growth. If you're a long-term investor, this shouldn't concern you. I figure in a few years, we should be past a lot of these concerns. I don't know. I'm speculating, of course, but I think for the next major bull run to happen, for us to really propel to new all-time highs for the banking sector as a whole, we need to get past this uncertainty, right? So we look at Bank of Nova Scotia, one of the hardest hit banks, down 7% after earnings. I think this was probably one of the worst earnings we've seen out of all the banks. But again, you have to define what you think terrible earnings are, because they did $9.3 billion in revenue. Again, a record revenue, incredible, up almost $1 billion from Q1 of 2024, that quarter for them. And if you take a look at provisions for credit losses at 1.16, again, continue to go up. Concerns that I do not like to see, but still lower than where it was in Q4 of 2023, a bit of a leveling off. If we take a look at that net income at $2.36 billion, was actually a record for Bank of Nova Scotia. So when you take a look at all prior, I mean, they're sitting in a fairly strong spot, right? I don't think there's any major concerns with these banks as it is today. If we take a look at Canadian Imperial Bank, another bank that's getting hit pretty hard, down 4.3% so far this year, dropping on earnings. Again, let's see if we see similar trends, right? Like when revenue's hitting all-time highs over and over again, it's quite impressive, especially again with all the concerns. $7.28 billion Again, record levels of revenue here. Provisions for credit losses actually have been leveling off a little bit better than some of the other banks at 573 million, still up from the last couple quarters, but not at an all-time high. But this seems to be the similar trend across all the banks right now. Net income, nonetheless, $659 million, a record level of net income, with the exception of Q1 of 2023. It looks like they did a bit more. Let me make sure I'm reading these lines correctly here. Yeah, so 659 million versus 739 back in Q1 of 2023, but still really high levels of net income over basically the last year or two. Nothing to complain about. When I scroll through these again, just taking a brief look at it, everything is strong. Again, payout ratios are continuing to stabilize and go to the downside. So they've got a lot of room for these dividends for those income earners that want reliable, sustainable yield. If we look at Bank of Montreal, similar thing. Bank of Montreal saw really good earnings. They were able to recover, though. They're up 6.7%, being one of the few banks, I think one of only two banks, being Toronto Dominion and Bank of BMO here, that have rallied on those recent earnings, right? And if we just take a look again, 9.26 billion in total revenue, record revenue. It's crazy that not one of these banks haven't posted a record revenue number. Provisions for credit losses are still high, lower than Q4, the quarter last time, but still higher than we've seen in the past historically. Overall, though, net income, 2.138 billion, a very strong place. I mean, these numbers are incredible. I don't know why anybody would be complaining that looked at these numbers, and I'm kind of shocked to see, the banks selling off on these earnings. Now, the strongest bank and the one that I was most surprised sold off was National Bank. It's down 8.5% and has actually trickled down quite a lot. It's down 14%, almost 15% from the all-time high. And this is probably one of the best buying banks that has had the strongest performance over the last 5 years, next to Royal Bank. And if we take a look here, when I was digging through this, I was shocked. I was like, look at the total revenue numbers here, $3.1 billion, man. I mean, this time last year, they were at 2.7 billion. If we take a look, let's find the net income numbers here. Firstly, income for the provisions for credit losses was significantly higher. Again, it's one of those banks that has seen really a big jump. But what's really intriguing is if you again take a look at that net income of 997 million, it is still in an incredibly strong place. With really great net income numbers. Now, they're not growing, and I think what's been some concern is this time last year was 922 million, but they're seeing double-digit growth, right? So, they're talking about almost, 90 million, 80 million jump in net income. When I looked at the actual percentage points, they were double digit. And again, the dividends and everything else remain incredibly strong. But why did the bank drop so hard? I couldn't really figure it out, considering they've announced that they're going to be purchasing the Western Bank of Canada here, the Western Bank acquisition, and it could reshape the earnings trajectory. And I'm not sure why none of this really got considered in the recent earnings, because when I looked at all of this, I was like, the numbers are pretty good here. Overall, the price to earnings multiple is lower than any of the other banks. The dividend yield is approaching 4%, which is quite attractive considering the small bank has had this absolutely historic run up. And I think they've got a lot of room to continue to run if they do another acquisition, because that's what's really helped propel Royal Bank. And like I said, if you want to get ready for really big run-ups in these companies, look at what Enbridge did with their purchase of that natural gas company. Look at what Royal Bank did. Anytime you see these big mega cap companies doing acquisitions to bolster their bottom lines and their revenues, it's usually a good time to be buying. And once those headlines hit, it's always a good time to dive into some of this stuff. But as a collector of Pokemon cards, I call my banks Pokemon cards because, like Pokemon, you got to collect them all. I think it's always better to just get diversity. A lot of people like the BMO equal weight bank ETF, though I do recommend Globex HBNK. It just comes with a significantly lower expense ratio than ZEB, and I think Globex is really trying to compete here. But somebody that likes market cap weighted ETFs, VDI till I motherfucking die. I love my Vanguard FTSE Canadian High Dividend Yield ETF. It gives me exposure to the higher upper weighted banks, being Royal Bank, Toronto Dominion. Those ones have been proving quite resilient, and nice to see that VDY is actually flipping to the green side this year, even on the lack of performance we've seen in some of the bank's stocks. But nonetheless, like I said, I think we're seeing continued buying opportunities, and as a long-term buy and hold investor, I know we're living in uncertain times, and these uncertain times tend to open up opportunities because people typically don't want to see the light that is eventually coming. I do not give myself major exposure to the Canadian economy. I primarily invest in the United States, but again, 20% of my portfolio continues to sit in Canada, and I will continue to cost average into this ETF regardless of the economic circumstance. I know you're going to be getting hit with a lot of negativity right now, but do not let that impact that idea of always be buying, especially if you have a 10, 20, 30 year time horizon ahead of you. But I will pass the question off to you. What do you guys think of bank earnings? How do you feel about the current market uncertainty? I'd love to hear about all of it in that comment section below.